So a couple things with stock are where stocks are sold. Now, you'll remember some of this may remind you from when we talked about financial markets and institutions in chapter 2 or 3, I think it was. So some of these terms may ring a bell. The primary market is where securities are sold for the very first time, sold directly from the company to the investor. And probably one of the most famous types of securities that people hear about are IPOs, which stands for Initial Public Offering. Now, they get a lot of press because a couple things. One, very often they're newer companies that have been pretty successful, and because IPOs typically on the very first day of trading in the U.S., the average stock price will jump like 7%, and so that's a lot more than most stocks in one day, right? In different parts of the world, this first day jump is even greater. And so that kind of helps grab attention of investors, and so while the market for IPOs isn't really that big, they do get some good headlines because of these first day returns and the companies involved, because they might be kind of famous companies. And I think the latest one, I think Airbnb is planning to try and do an IPO still pretty soon. I was kind of surprised to hear that, but IPOs are typically done when stock markets are really good, when prices are high. That's when most companies would like to do their IPO. Something to take into account, like why do companies do IPOs? Well, the two main reasons are one, when a company gets sold publicly to the public market, so it goes from private to public by doing an IPO, the value of the company will go up like 5, 10, 20, 30% just by going public. The second reason is because once a company is public, it's much easier to buy and sell their shares. And it's much easier to buy and sell their shares because private company stocks, there are restrictions. And very often you have to be a qualified investor to buy shares in private companies because the risks involved. And the government actually says you have to have, at least like a million, 10 million in assets just to be able to legally buy shares in some of these companies. The first reason about the market value going up, think about it like this. If you were to sell, let's say you were to sell a car, you sell a used car, and you went to the people who lived right around you, and you try to find the best price you could get, and say you talk to like 4 or 5 people. The price you get may not be as high as you hoped for, I'm guessing, right? But now, what if you go to the whole city, the whole state, you put it on the biggest website, you go to all the dealers you can think of to try and get the best price possible? Chances are you're going to get a much higher price than if you only look at the 4 or 5 people who live around you, right? So that kind of analogy works in private companies, because private companies can only be sold to a few amount of people, wealthy investors. When they go to the public markets, now anybody can buy it, right? And so the value of the company becomes greater because the supply of potential investors goes up. And the demand goes up, basically. The demand for the shares goes up because of all these investors. So, and then, employees who own shares in the stock, now it's easy for them to sell their shares. A lot of companies, in addition to salary, will often give shares in the company to employees to incentivize them to do well, or in lieu of compensation, or in lieu of higher compensation. And so when a private company goes public, it allows some of their employees to kind of get some of that that wealth that they've got tied up in company stock. We also have something called seasoned equity offerings. And so by seasoned, we mean companies that are already public. Now, usually this is not good news when a company does an SEO, a seasoned equity offering. It's kind of like, imagine if a friend of yours said, hey, I'm starting on my own company. I'd like you to invest in it. And they sell you some shares in that company. Okay, sounds good. And then let's suppose a year later, they come back to you and say, you know what? I need you to invest some more money. And you're like, well, what happened to the money you already had? And so you're kind of like, you're a little nervous because this sends a bad signal, right? It means they've kind of run out of money and they need to get more money. And in the world of getting capital for a business, equity investors are thought of as like the most expensive, meaning like you have to give up a share of your business to get equity investors. And if a company can handle debt, debt is usually much preferred to selling more shares of stock because debt can be relatively cheap. 3, 4, 5, 6, 7, 8% per year is a lot cheaper than handing over part of your company to someone else. So seasoned equity offerings, they do happen. They're not the most common, but when they do happen, usually investors aren't too happy about it. So common stock is defined as the ownership shares in a publicly held corporation. And typically after the IPO, these common stock shares will sell then in the secondary markets. So initially the company sells it directly to the very first buyer, and there's an investment bank in between that facilitates that transaction. But then after that, now when that first investor wants to sell the stock, they have to go to the secondary markets, and those secondary markets are like the New York Stock Exchange. That's where you go to your stockbroker and you can very easily buy and sell shares of stock. That's the secondary market. One way to pay equity investors is for companies to pay dividends. And dividends are typically quarterly payments, and they're given in terms of dollars per share. So it depends on how many shares you own, and you will get a certain amount of dividend every quarter. There's now young companies that are still growing, that are still investing in their business a lot, will typically not pay dividends because they want to conserve their money so they can invest it in developing new products, marketing, that type of thing. For many years, Apple Computer did not pay dividends, and it wasn't until later that they started paying dividends based on, I think they got a little pressure from investors because Apple was building up a large cash hoard, if you will. And the alternative to paying dividends for companies that start getting lots of profits is to do a stock buyback. So this is an alternative to a dividend. In a stock buyback, the company will announce that they've authorized a certain amount of money and that over the next couple months, they may or may not be buying stock on the open secondary markets. So companies can go in the market, they can go to their own stockbroker, and they can go to the New York Stock Exchange and buy stocks just like you buy them. But when the company buys those shares of stock, they get put back into the treasury, and now they no longer count as shares outstanding. So the number of shares outstanding in the market drops when a company buys back their own stock. And so this is seen as an alternative to dividends. And the reason is, what the company is doing when it buys back shares of stock, it's giving money to shareholders, right? And technically, a dividend is money to shareholders as well. So when they buy back stock, they give money to shareholders. But the one caveat, obviously, being that they're not giving money to all the shareholders, only the ones who are willing to sell their shares of stock. So why would a company do one versus the other, a dividend versus a stock buyback? And I'm kind of going into this a little because I think over the last 4 years or so, companies, it was in the press a lot how people were upset that companies were doing too many stock buybacks and they weren't investing their money, right, in capital investments and things like that. Dividends kind of have a little of a, I'll call it a dark side. And the dark side to dividends is that once you set up a dividend, investors expect it to continue and possibly grow for a very, very long time. So that if for some reason you ever needed to reduce a dividend or temporarily stop paying dividends, that sends a negative signal to the stock market, and a drop in the stock price is likely. What this means is that when companies pay a dividend, they'll, one, do it relatively small, a small amount that they're very confident they never have to cut. And two, they're going to be darn sure that they can continue it for this foreseeable future without any issues. And because of that, there's this strong expectation that dividends will stay the same or grow consistently in the future. Companies are hesitant to increase dividends to a large amount, right? If they have one good period, they're like, we're not increasing dividends just because of one good period, because dividends, the expectation is they go on forever. If we have one good period, we're not going to increase the dividend a lot. Instead, we'd rather do a stock buyback. And what happens in a stock buyback, when the company buys back those shares, right, it reduces the number of shares outstanding. And so the existing shareholders who don't sell their shares, their stock value will go up because now they have a bigger piece of the pie, if you will. They have a larger ownership percentage of the business. And so that's what companies have been preferring. They prefer to do stock buybacks. And really the stock buyback dividend decision is totally separate from capital investments, right? If they need to invest the money, that's a separate decision. That's the investment decision. If they want to do dividends versus stock buybacks, that's a financing decision. And so don't get too caught up in whether or not companies are doing stock buybacks or dividends or capital investing. They're really two separate decisions. And so if companies are not investing enough, that's a separate decision, and it shouldn't be confused with stock buybacks. We talked about the PE ratio before, and that's the price per share divided by earnings per share. It's probably the most popular financial ratio used to judge how expensive or cheap a company is based on how much you have to pay per dollar of earnings. Like if you were to judge the price of coffee based on dollars per pound, right? If you were judging companies, it'd be based on the PE ratio. Book value is basically, the assets minus liabilities from the balance sheet. We looked at that before. Liquidation value, that's basically what's left when you sell everything off of a company and pay off all its debts. What you have left is after liquidating the company, and that's called liquidation value. We'll talk about these a little in a couple slides here, but they're basically ways of looking at the value of a company. Market value balance sheet is basically where you recast the financial statements, specifically the balance sheet, by attempting to use as many market values as you can. So things like fixed assets, things like some of the liabilities as well. So here are the stock valuation models we're going to cover. We're going to look at book value as a valuation model, liquidation value, valuation using comparables like we did when we did financial analysis. Remember, we looked at PE ratio and a couple other ratios. That's probably the most popular way to value companies, is really with comparables. People also use time value of money, but the nice thing about comparables is it's very easy to communicate to everybody, and it's a way to ensure that you've got, what's happening in the market taken into account, because time value of money is a little bit more independent of what is happening in the market in a way. The market value of equity is also another way. That's basically the price of stock, right? Multiplied by the number of shares outstanding. That's the way to look at how to value a company. Because what we're saying here is that we're looking at different ways to value a stock. And just because we can look up the price per share or the value of a company in the stock market, doesn't necessarily mean that's what we think it's really worth, right? Because you can look up, I don't know, the price of something on eBay, but if you're an expert at that whatever that product is, you might say, you know what, I know how much it's really worth based on how I value things, and I don't think that market price on eBay is really a good price. And so we're doing the same thing here, because the stock market doesn't always give us a really good price, because sometimes the stock market goes a little crazy and prices go too low, or sometimes the prices go too high. And sometimes we want to buy a private company, in which case we have no stock market to really value a private company. So when we value stocks, we usually use 2 or 3 different methods, and we kind of triangulate in what we think is the real value of something. Excuse me. And the final method we're going to cover is a dividend discount model. There are a few more methods that, if you're a finance major and take corporate finance class, you'll cover a couple more methods, but this will be it for this class. So, stock valuation using book value. So we know the book value of equity is basically assets minus liabilities, right? And the assets in this case, we remember, they're kind of recorded at historical costs minus depreciation, and the liabilities themselves could also be recorded at historical value. And so this does create some concerns, right? Because if we want to know what the value is today, in some instances we have to ignore what the historical costs are. So let's say if we were looking at a real estate company in the Bay Area, and they bought an office building 25, 30 years ago. I would venture to guess that what they paid for it back then is not realistic in terms of evaluation, even after you take away depreciation, right? So the issue with using book value of equity is it's somewhat backward looking, and it's not always relevant. That being said, there are still some investment strategies that use it. Warren Buffett being one of those. Stock valuation using liquidation. So this is where you could buy up a company, sell off all the assets, and really it means firing everybody too, right? And then paying off all the debts, and then keeping what's left over. It sounds a little evil, right? In fact, I have a friend of mine. I guess it's just evil. I shouldn't say he's a friend of mine, but he was in the business of buying up regional business magazines. And so regional business magazines are like, I think we have one for the Bay Area. I don't remember the name for it. and they usually carry advertising, especially with a lot of realtors who are selling to companies, companies acquiring office space. They'll talk about like most up and coming business executives and things like that. And and really over the last 20, 30 years, a lot of these businesses have kind of underperformed. They haven't done too well. And so he hit upon a strategy where he would buy up these companies. He would basically fire all the employees except for the top couple salespeople. Everybody else will be gone. But the best salespeople he would keep. He would farm out all the news stories in the magazine to independent story writers all around the world, well, mostly around the United States, who would write stories at home on the computer. And then he would tell all the creditors that he was likely going to go bankrupt, and that unless they took like a 50-80% haircut on their debt, that they were probably going to get nothing in a bankruptcy. And so he was usually pretty successful with negotiating the debt owned down to a relatively low number. And now he didn't really liquidate everything, but it kind of reminds me of this a little. And so it's, you got to be a little of a tough person to be able to do that, because you're really messing with a lot of people, right? But that's liquidation. So you got to fire people, and you got to sell stuff, and you got to negotiate hard with debts. I don't think most people have the stomach for it, but he did. All right, I'm just going to take a couple minutes on this slide. This will be the last one for today. The other thing, when using comparables, and PE ratio being a very popular one, you also see here on this slide, we have listed the price to book ratio. So here's the price to book ratio, here's the PE ratio. And the key when you're using ratios is that you compare the company's ratio to the industry average. And what that really does for you is it tells you whether or not your company is more or less expensive than the industry average. And so, for example, let's take a look at Walmart right here. So if we look at Walmart, the PE ratio was 14.8. That's the company right here. But the average for large general retailers at the time was 17.9. So what this says is that Walmart, per dollar of earnings, is less expensive than the industry average. And now you have to decide, is that reasonable? Maybe their growth prospects aren't as good. Maybe they're underperforming and they're not going to grow as much. So there could be a lot of reasons that PE ratios are higher or lower between companies within the same industry. But very often people like to use these multiples within the industry to get a gauge for how much a company should cost, and whether the company is too expensive or too cheap or cheap because of that. And so it's kind of a guide to let you know how cheap or how expensive the company is. It doesn't necessarily give you a specific dollar value, but what you can say is, Walmart, it's trading at 14.8. They're going through some trouble right now. And I think after they fix their problems, they're going to trade at the industry average of 17.9. So now you can use that industry average 17.9 and forecast what the stock price would be if they had a 17.9 PE ratio. So you would take the earnings per share and just multiply it by 17.9, and it would be a way to get a value. So I'm going to leave it at that for today.